When two people with different levels of experience cross paths, the one with experience takes the money, and the person with the money departs with experience. On his 87th birthday, Warren Buffett said this when he asked for his best investing advice. He claims that the secret to success as an investor is experience. What about folks who are brand new to investing though? What happens if you lack any experience? Fortunately, you can learn from experts in the field such as Warren Buffett. In today's video, we're going to talk about Warren Buffett's tips for investing strategies. Watch the video till the end to find out about these interesting investing strategies that'll make you rich. Let's get started. Number 1, it's not always a good idea to diversify.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know.
Wise investors strongly emphasize the value of diversity. Warren Buffett, though, frequently rejects the notion. According to Buffett, diversity is best left to novice investors. A seasoned investor should pick stocks with long-term in mind and have confidence in their purchases. Because they're concerned that a single stock may wipe out their whole portfolio, some investors diversify their holdings, but doing so makes it much more difficult to monitor the present circumstances affecting each firm. By diversifying, they may be able to lower the volatility of their portfolio, but they also lessen the emphasis they place on certain investments. Buffett watches for opportunities to purchase high-quality stocks and seizes them when they present themselves. As stated by Buffett, when gold is falling, don't use a thimble, use a bucket. Number 2, put your own needs first. Your ability to invest in yourself is the finest investment you can make. Anything you can do to advance your skills or business will probably be more fruitful. The finest investment a person can make, according to Warren Buffett, is their skills. The stock market won't be where most people generate the majority of their income. They'll succeed in their professions, so prioritize yourself. Charlie Munger, Buffett's business colleague, had a similar idea. Munger's golden rule for success is to devote an hour a day to improving oneself. The key to success, which applies to more than simply investments, is to invest in yourself.
Generally speaking, investing in yourself is the best thing you can do. Anything that improves your own talents. Like, nobody can take it away from you. They can run up huge deficits and the dollar can become worth far less. You can have all kinds of things happen. But if you've got talent yourself and you've maximized your talent, you've got a terrific asset.
Number 3, have faith in your ability to succeed as an investor. According to Buffett, having faith in your investment choices is one of the toughest things to do. You consistently believe that others are correct and you're mistaken. You should study and have confidence in yourself instead.
A little bit interesting. Let's say you'd taken that $10,000 and you'd listen to the prophets of doom and gloom around you, and you'll get that constantly throughout your life. And instead you'd use the $10,000 to buy gold. Now, for your $10,000, you would have been able to buy about 300 ounces of gold. And while the businesses were reinvesting in more plants and new inventions came along, you would go down every year and look in your safe deposit box, and you'd have your 300 ounces of gold, and you could look at it, and you could fondle it, and you could, whatever you wanted to do with it. But it didn't produce anything. It was never going to produce anything. And what would you have today? You would have 300 ounces of gold, just like you had in March of 1942. And it would be worth approximately $400,000. So if you decided to go with a non-productive asset, gold, instead of a productive asset, which actually was earning more money and reinvesting and paying dividends and maybe purchasing stock, whatever it might be, you would now have over 100 times the value of what you would.
You must get over your fear and stop listening to what other people are telling you if you want to succeed. It's as Buffett says, there will always be prophets of doom and gloom. Build up your expertise and make independent investing choices to set yourself apart from the competition to come out on top. It's not about timing or playing the market when you invest. It is critical to achieving financial well-being. This is a critical point to understanding how investors can outperform the market. You also need to follow the steps and objectives that go beyond being able to outperform the market. You need to be able to handle expenses like credit cards, loans, and student loan payments. If you find yourself in financial difficulties, selling down on your portfolio might be necessary, and as such, the long-term performance might also be affected. These days, starting an investment portfolio is simple, even if you have a modest quantity of excess money. You may invest as little as $5 in fractional shares using investment apps like Stash, and commission costs are either non-existent or extremely low. However, it's important that you first ensure that your finances are in order before you begin investing. Before you start investing, you should build up an emergency fund, make contributions to retirement accounts like 401ks and IRAs, and pay off any high-interest credit cards. Although many individuals only consider interest when it comes to credit, you may use interest to your advantage when investing as well. The secret is to get an early start on investing to make sure that all earnings and interest payments on your assets are reinvested automatically. Compound interest will speed up the growth of your investments over time. Use your money to your advantage. Number 4, stay in your circle of competence.
Defining your circle of competence is the most important aspect of investing. It's not how important, how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. Tom Watson Sr., who started IBM, said in his book, he said, "I'm no genius," he said, "but I'm smart in spots, and I stay around those spots." And you know, that is the key. So if I understand a few things, and I stick in that arena, I'll do okay. And if I don't understand something, but I get all excited about it because my neighbors are talking about it, and the stocks are going up and everything, I start fooling around someplace else, eventually I'll get creamed, and I should.
Buffett advises against making investments in companies you don't completely understand. He claims that in little more than 10 minutes, he can learn how a firm generates revenue and the key factors affecting its industry before investing in its shares. He moves on to evaluating another firm on this basis if he's unable to comprehend it in 10 minutes. Most people are unable to foresee adolescent fashion trends or if a pharmaceutical will be popular on the market. Even if you had access to more data than anybody else, you couldn't accurately predict the future. Buffett cautions against investing in circumstances where a precise future projection is necessary. Simply search for other firms to invest in if it's too complicated for you. Before even considering valuation, Buffett previously stated that he would only prefer to invest in a small number of the approximately 10,000 plus publicly listed companies. Make sure to subscribe to our channel if you're enjoying the videos so far. Number 5, keep an eye on the news you read. One of Warren Buffett's pieces of financial advice is to avoid placing too much stock in every single news story you come across. Buffett is a proponent of the 99-1 rule. The majority of investors base their decisions on just 1% of the financial news that they read. As a result, anytime bad news is announced, for instance, that a company's revenues have decreased by 10%, they promptly sell their stocks. Buffett claims that the corporation in this case is undoubtedly capable of withstanding such disasters if it has been in operation for, say, 100 years. Individuals frequently tend to overreact. Number 6. Purchasing a company's stock is equal to purchasing a stake in the company. Imagine investing in the neighborhood convenience store that is right around the corner from your home. You'll automatically consider the opposition, suppliers, pricing, etc. You must consider both the specific site and its position in the market in terms of competition. Similar to how business owners do it, you must consider all of these factors when purchasing stock. A stock is more than simply a piece of paper with a ticker symbol when you purchase one. Purchasing corporate stock entails acquiring ownership in a firm. Buffett's investment strategy is based on establishing a margin of safety. In basic terms, a margin of safety refers to aspects of an investment that serve to safeguard investors from losing money. For example, if a stock is trading at $10 per share, but the company's assets are worth $12 per share, there is a $2 margin of safety. The worth of the assets should keep the stock price of the firm from falling too far. The obvious purpose of stock trading is to buy low and sell high, yet human nature can lead us to do quite the opposite. When we see all of our friends generating money, we feel compelled to strive to make money as well. When the stock markets crash, it is our human instinct to sell before prices fall significantly low. Number 7. Correct your mistakes and move on. You might be surprised to learn that even Warren Buffett makes mistakes, and huge ones at that. However, he ensures that he learns from his mistakes. Buffett recommends maintaining a record of your blunders so you know what went wrong in order to avoid repeating the same mistakes. Buffett goes on to suggest that you should share these lessons with your children and grandchildren so they don't make the same mistakes that you did. Number 8. Avoid day trading. Warren Buffett is largely regarded as the world's best value investor. Value investing emphasizes paying modest prices for investments in comparison to their underlying merits. The purpose of a value investor is to acquire $100 worth of a company's shares for less than $100, preferably considerably less. Value investors seek out and invest in firms that have intrinsic values that are significantly higher than the enterprise values represented by the levels at which their stocks trade. Value investors such as Warren Buffett believe that the market will ultimately appreciate an undervalued company's true value, resulting in an increase in the company's stock price and a return for the value investor. Buffett believes that the key to maximizing return on investment is to acquire stock and then forget about it. He believes in the buy and hold strategy and has held equities for decades. This is based on two principles. 1. If you acquire stock for less than its real value, the price of the stock will ultimately converge with its value. And 2. If you acquire a fantastic business, the value of that firm will compound and expand tremendously over time. As a result, the patient investor will be rewarded in the end if they hang on to their equities for a longer period. Warren Buffett claims that if you regularly purchase and sell stocks, you would lose a considerable portion of your profits due to trading costs and taxes. As a result, it is preferable to purchase excellent stocks and retain them for an extended period. Observing the best. Warren Buffett is possibly the clearest example of the power of compounding over time. Buffett benefits from compound interest, dividend reinvestment, and the ability to consistently reinvest the operational cash flow created by Berkshire's businesses. How potent is this? Since Buffett took control in 1964, Berkshire has averaged a 20.1% annualized return compared to the 10.5% for the S&P 500. This may not sound like much until you consider that over time, shareholders have seen a total gain of 3,641,000 and 613% as a consequence, compared to the S&P 500's gain of only 30,209%. We hope you enjoyed these investment tips from Warren Buffett, which practically anybody can use to become a great investor. Regardless of your level of experience, you may use these financial tips to improve your investments. Buffett advises individuals who are still utterly clueless to either use index funds or seek advice from more seasoned investors, but just make sure your investment advisor isn't making silly mistakes. Which of these Warren Buffett financial tips did you like the best? Tell us in the comment section below. I hope you enjoyed today's video. If you liked the video, please don't forget to subscribe to the channel and press the bell icon.